This is a special edition of Macro Voices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of Macro Voices, here's hedge fund manager Eric Townsend.
Macro Voices All-Stars episode number 39 was recorded on July 29th, 2019. I'm Eric Townsend. Alhambra Investment CIO Jeff Snider is back with us again this week. We received a ton of emails and tweets with listener feedback from our July 15th interview with Jeff, and it's great to see so many people paying such close attention. Quite a few listeners got the impression that Jeff was making a seemingly novice mistake when he characterized IOER as creating a ceiling for the Fed funds rate, where several listeners sent us links to the Fed's own blog posts explaining why IOER is intended to act as a floor below Fed funds, not a ceiling above it. Folks, I assure you, Jeff was not making such a novice mistake. He's well aware of the Fed's view on the subject. He simply disagrees with that view. So I probably should have done a better job of making that clear by asking Jeff to explain why his views differ from those of the Fed and other analysts. This week, we're going to dive into this subject in much greater detail. We'll also touch on Luke Grohmann's views expressed in another All-Stars interview, which differ from Jeff's. As usual, Jeff prepared a fantastic slide deck to accompany today's interview. You'll find the download link on our homepage at macrovoices.com next to Jeff's picture and the description of this interview. For the sake of context, our episode back on July 15th focused on an incongruence between a market rate, the effective Fed funds rate, and an interest rate set directly by the Federal Reserve, interest on excess reserves. Jeff, as a very brief recap for our listeners, let's start with what has happened with these two rates over the past year.
Thanks, Eric. Let's start on slide 3. Now, the federal funds rate began to rise early on in 2018, starting out about 16 basis points above the policy range's lower bound, a little bit above the midpoint in the policy range. Over the course of several months, it crept higher until June 2018, when the Federal Reserve began to react to it. Calling them technical adjustments, the FOMC lowered IOER 3 times over the past year, 5 basis points each, in order to influence the federal funds rate back lower. Each time IOER was reduced, the federal funds effective rate would fall in line, and then it would head back higher again. In March of this year, the effective federal funds rate moved above IOER, and it has mostly remained above since then. And since mid-April, the Fed funds market started to behave a little erratically, too.
Okay, so when you say erratically, what specifically do you mean when it comes to how these two rates behave? Is the IOER supposed to act as a floor or as a ceiling for the effective Fed funds rate?
Okay, let's go into slide 4. The conventional and official answer is that IOER is a floor, kind of. Both the history of IOER as well as its current treatment imply that it's more complicated than all that. So let me begin to answer the question with a little bit of review. The effective federal funds rate, as well as its range, had plunged during the worst parts of the global financial crisis. Now, it's not quite the picture you get of the panic of 2008, but that's how it went. The federal funds rate, which is the Federal Reserve's main policy rate, was often way, way below the monetary policy target. Now, the purpose of IOER, its original purpose, was to get the rate back up to its target, to act as a hard floor, except that it wasn't. It never worked out that way. And so for the rest of the panic period, you had the weird case of the federal funds market well below the target rate, as well as well below IOER, which after not much time was set equal to the federal funds target.
Okay, so that's the background from 2008 and 2009. What about what's going on right now in 2018 and 19? Where does IOER fit into the current landscape?
Okay, flip to slide number 5. In order to explain the discrepancy, the Fed created a doctrine of what it calls abundant reserves. Yes, they are actually claiming that during the worst financial conditions since the Great Depression, there was an abundance of reserves. And all that does is raise question about what are the role of reserves in this wider system. IOER has been assigned since then as specifically a bank rate. And for official purposes, it is still classified as a floor, but now it is understood as a double floor because it doesn't really apply to the wholesale market of federal funds. The floor for the wholesale federal funds market is something called the reverse repo. So the doctrine of abundant reserves says that because there are trillions of bank reserves, there's no demand for this wholesale funding. The only people who are in this one remote wholesale corner are those who are ineligible to receive IOER, which are some foreign banks and primarily the Federal Home Loan Banks. Now, if we go to slide 6, because monetary policy is conducted via the Fed funds rate, which is this wholesale market rate, in order to keep it in what's now a policy range, the Fed has deployed this double floor system. The floor is the wholesale floor, which is the reverse repo. And IOER, which is the bank floor, is put on top of the policy range. So from the perspective of federal funds, which is what matters for monetary policy, IOER looks like a ceiling.
Jeff, at some point, we're going to have to do entire episodes on repo and reverse repo and that whole system. But for now, I want to stay focused on this topic. So it's clear now that the Fed thinks it's supposed to be a floor or wants it to be a floor, but it hasn't really worked out as a floor. But does it actually act as a ceiling now, or does it just not quite work very well as a floor?
Well, again, as I said before, these money markets are, as you're pointing out, much more complicated than they're made out to be. So it isn't a hard limit whereby there's no possible way for federal funds to get above it. In fact, it is expected that this will happen. Remember, the federal funds is a range. When parts of that range get to and above this wholesale ceiling, which is the bank rate floor, I know we're kind of confusing terms here, it triggers a decision point. Does a depository institution receiving the bank rate of IOER pull out those reserves and plunk them down into federal funds to take advantage of a better opportunity? On slide 7, the more the federal funds range rises above IOER, the more that is supposed to happen. Indeed, that's exactly what policymakers are expecting to happen, which is why they've reduced IOER 3 times. The floor for banks acts like a soft ceiling for wholesale, meaning that it's not necessarily a ceiling, but it's a filtering point. When federal funds runs up against this filter decision point, it's supposed to trigger a counter response from banks, which will influence the average, which is the effective federal funds rate, to keep it from going above the upper bound set by monetary policy, which is the real ceiling. Now, how that actually works is even more complicated still, especially since lending in the federal funds market is not directly equivalent to holding bank reserves with the Fed and getting paid IOER. There are frictions to consider, meaning that banks aren't going to jump on Fed funds for 1 or 2 basis points. But as the top of the Fed funds range got as high as it did, there was opportunity for banks that was left on the table. When IOER was 240 just a couple months ago, the 99th percentile of Fed funds was up around 260. So even now, the IOER is down to 235. The 99th percentile of federal funds range is still around 245, which means it has narrowed, and that IOER has in fact induced some banks to take advantage of federal funds, but not enough to influence the effective rate.
Okay, so does this behavior imply that there's an imminent or impending liquidity shock that's coming?
No, there's nothing that says that impending nor that this is a liquidity shock. What it might represent is an escalation of conditions which already exist elsewhere. So all we can really say is that there is something going on, which is also the position of the Federal Reserve, too. I mean, that's why they've reduced IOER 3 times, and they're even discussing and maybe even likely to implement what's called a standing repo facility.
We really got to get into repo facilities and repo in general, but we don't have time to do it here.
Yeah, that's a whole other set of complications, and you're right. I think we want to stay focused on the topic at hand. So many would say that all this IOER and EFF stuff is just growing pains on the road to normalization. It's quantitative tightening and whatnot. But normalization in 2019 has been postponed, and it's been replaced by growing uncertainty and, yes, illiquid behavior in a lot of other places.
Okay, given that it's such a small market and that this does not signal an imminent liquidity shock, then why are we even raising the issue? Why did you bring this up back on July 15th? Is this symbolic of some larger thesis that our listeners should be paying attention to?
Yeah, that's ultimately what my point was, and I probably didn't make it well enough. There's more going on outside of federal funds, but what has drawn our attention to federal funds is that even in this out-of-the-way small corner of the larger wholesale world, what might it say that depositories might be sitting on the sidelines, reluctant to get more involved in the manner policymakers were expecting them to? Now, if you look at slides 8 and slides 9, again, it's one piece of a larger puzzle. And it's interesting that it has gotten the Fed's attention. Obviously, policymakers aren't going to say this is a big deal. They're just fine-tuning their tools. That's what they're going to tell you. But experience in these matters doesn't actually give them the benefit of the doubt.
You brought up last time how in June of 2018, the Fed mentioned special factors when undertaking its first technical adjustment. Then that explanation of special factors just quietly disappeared. What's going on there?
Well, I think Jay Powell and the FOMC committee were obviously expecting the one technical adjustment back in June of 2018 to do the trick. Instead, a couple of months later, the effective federal funds rate was actually got up to be even with IOER, which was materially different than before the first adjustment. So whatever special factors they had in mind, and they never specified what they were, they didn't directly specify what they were, they didn't seem to be the right factor. So, again, it raises the issue. Do we just take the Fed at its word? The proposed standing repo facility that they're talking about now says they don't even take themselves at their own word. And again, that doesn't mean that a crash is going to happen tomorrow. What it might propose is that the situation in terms of wider liquidity, a dollar shortage, is escalating, that tensions are mounting and pressures are rising. And it may even be that showing up in federal funds of all places, the Federal Reserve isn't really quite sure what to make of it. Then again, that's really nothing new.
Jeff, we recently had Luke Grohmann on a separate All-Stars interview, and Luke expressed a different perspective on what was perhaps implied by Fed funds moving above IOER. The way Luke sees it is it's an ever more daunting U.S. federal deficit, and he felt that this is an issue of balance sheet capacity, and specifically that primary dealers are contending with something akin to a low-level buyer's strike by the U.S. private sector, and thus being forced to absorb more treasuries than they would like. What do you think of Luke's view that this really is all about the Fed reacting and creating a way for the system to absorb larger federal deficits?
Well, let me just start by saying that I agree with much of the background behind what Luke is saying. I mean, there is no doubt, there can be absolutely no doubt that the U.S. federal government is the brokest institution humanity has ever conceived, and is getting broker by the day, even by the minute. So by any reasonable and honest measure, it is insolvent. Now, where I deviate from Luke is in placing that realization in the hierarchy of priorities. Now, let me be perfectly clear. I'm not saying that this credit risk isn't important or even potentially devastating. What I'm saying is that in the world of U.S. Treasury securities, the bonds, the notes, and the bills themselves, that's something to worry about down the road. There are much more immediate problems today.
Okay, Jeff, if I'm following you correctly, it sounds like you're saying that treasuries and other sovereign bonds are not strictly fixed income investments that you buy for the sake of getting whatever yield they return, as an investment you're going to make money from. So if that's not it, then what purpose are they serving?
Well, you have to think of these things as balance sheet tools for the banking system rather than investments, because around the world, that's just how they're used. Now, it's more obvious that's what actually goes on in other places like Germany and Japan, for example. Their bonds yield nothing. In fact, you have to pay for the privilege of holding them. And in Japan is perhaps second only to the United States in terms of being broke. Yet the Japanese have proved that credit risk isn't paramount, no matter how much in terms of their debts and deficits. Now, I understand what people say is the difference between the U.S. and Japan is that, Japan can finance its own deficit and debts.
Well, Jeff, I think that topic of how sovereign bonds are being used in the banking system, because clearly it doesn't make sense to have them for the sake of the negative yield that they return in the case of German bonds. That's a topic for yet another episode. And if we have interest from our listeners, we'll pursue that one as well. But I want to come back to where we left off. Clearly, the Japanese, in that example that you cited, they can finance their own deficits internally within their country. But the U.S. has to depend on the kindness of strangers, of foreigners. They need foreign buyers, or else the whole house of cards comes tumbling down.
And that's just what we've been told time and time again. So if you flip over to slide number 10, last year, all the so-called bond kings were up in arms. The U.S. Treasury market was going to blow up. Interest rates were going to go much, much higher. Other people piled on and said the U.S. dollar would go to zero as a result. And all because, if foreign buyers stopped buying U.S. paper, we were dead. There was no other way around it.
Well, wait a minute, Jeff, because that's maybe it's another episode, but that's exactly what happened. Everybody said we were dead. Well, they did stop buying, yet interest rates are lower and the dollar is higher than when they all stopped buying.
Yeah, and it was even worse than we were supposed to fear. Slide 11 now. Foreigners didn't just stop buying treasuries, they've been outright selling them, and by the bushelful, by the hundreds of trillions. According to TIC, which is the Treasury Department's Treasury International Capital data, going back to last year, more than 300 billion specifically of U.S. treasuries has been sold by the foreign official sector.
Okay, so something's missing then. What is the missing piece that explains this?
Well, the idea that primary dealers and banks in general are being stuck holding the bag was first raised in early 2016, the last time this all happened. And by this, I mean a dollar shortage. What they said then and what some are trying to say now is that foreigners are selling their treasuries for whatever reasons and the dealers are stuck buying them. Go to slide 12 now. You can see once they have them, they have to finance them in the repo market, which has the effect of raising the repo rate because of an overwhelming demand for funding. And as luck would have it, given the topic of we were talking about before, the rise in the repo rate also tends to affect the federal funds rate in the same way. And as we'll see again when we get to slide number 18.
So foreigners sell, primary dealers buy, and then being stuck with all of these treasuries, it might seem to disrupt the funding markets.
Yeah, that's the story. But what's never explained is why the primary dealers don't just sell them. I mean, they are, after all, dealers. So that's their whole job. That's their one primary task. They're supposed to take in securities and dispose of them over time to the public. And especially if it's causing disturbances in funding markets, why not just sell these treasuries to the public? And it's not like they would have any trouble. I mean, look at interest rates. There's an overwhelming demand for U.S. Treasury paper. That's why, despite all of this foreign selling, interest rates are lower. If hoarding U.S. Treasuries was a problem for dealers, they'd have no problem in selling them and making money on the sale. So instead, they hold on to them. They quite purposefully hold on to them. And again, this is not the first time this has happened.
Okay, you mentioned before that it came up in 2016. So what happened then?
Yeah, actually 3 times before, 2016 being just the last time. So all of these correlations repeat. And they have nothing whatsoever to do with credit risk. In fact, these are banks setting aside credit risk because they're focused primarily on liquidity risk, pure and simple. You know, Basel III and the liquidity coverage ratio only codified what banks had been doing for years before them. Treasuries like German bonds or JGBs, these are balance sheet tools and they're liquidity protection for when things might get rough. If you go to slide 13, that was the lesson of Bear Stearns way back in 2008. Now, people mostly refer to Lehman Brothers, but it was Bear which first exposed the flaws in the system. And it was Bill Dudley, ironically, who spelled out exactly what that had meant at the time, even though he obviously didn't take his own words to heart. What overrides the credit risk of tomorrow is the prospective kill shot of today. I mean, you have to have a margin of liquidity, not because Basel III says so, but because in this dollar world after August 2007, that's the reality. Long before there was ever, even a Basel 2.5, or just as Basel II was being finished, banks, especially these primary dealers, have tended to hoard treasury during dollar shortages. And, that's why these correlations hold and why they repeat. This isn't the first time what we're seeing now. This isn't the first time this has happened.
Okay, what do you mean by correlations? Which correlations specifically?
Let's start with foreigners selling treasuries. Why are they selling? Some people say it's credit risk. Some people say it's because they hate the U.S. government because of its bullying politics, or they just want to ditch the dollar. But foreigners in the aggregate actually buy less U.S. dollar assets and even outright sell them on a few occasions during these times when markets and prices and indications show us doubts about liquidity. If you go through slides 14, 15, 16, 17, and 18, what you'll see is these correlations, whether it's swap spreads compressing, which is one deep measure of liquidity perceptions, and another potential topic for a deeper dive, whether it's Eurodollar futures, repo, its hierarchy, all of these correlations cluster together at the same times, which are the same times foreigners tend to buy less U.S. dollar assets, including treasuries, and even sell them. So in other words, during the periods when markets indicate a more acute dollar shortage, foreigners have to work around them by redistributing their dollar assets, which includes sometimes liquidating them.
And then the primary dealers buy them because they want them for their own liquidity margins. If they didn't want them, they'd sell them to the public because at the same times that you're talking about, interest rates are falling, which seems to imply if interest rates are falling, that means there's demand for treasuries. The public would buy them if they had the chance.
Exactly. And we have even more evidence that comes from the Federal Reserve. The New York branch operates something called the foreign repo pool, which is something we talked about, I think, a month ago. They operate this foreign repo pool on behalf of foreign governments and central banks. Now, these governments and central banks hold what are called dollar buffers at FRB&Y because of the natural organic global trade and monetary flows. So if you go to slide 19, an individual country will have to have some positive balance on account with FRB&Y to settle the thousands, millions, perhaps billions of transactions that flow through New York and are netted there. It's one of the last remnants of what used to be called the old correspondence system. Now, while these countries hold these dollar balances, as an accommodation, the Fed invests them in its own repo system, which is collateralized by its U.S. Treasury SOMA holdings. That's why it's called the repo pool. But the foreign repo pool is really a dollar buffer intended to address primarily any possible dollar shortages that might arise. When the Fed says dollar shortage, it means it for specific countries. A hypothetical example would be Argentina, a country for its own flaws that might be having dollar funding and dollar flow problems. That's not something the Fed would be concerned about because they think it's a problem for Argentina to get its own house in order. But if we, again, looking at slide number 19, but what if it's not just Argentina? What if this is a systemic issue? We would expect these dollar buffers to rise in the aggregate.
I can see that's just what happens.
Yeah, it all fits together pretty neatly. The dollar shortage, which leads to distressed liquidity indications across a range of markets and prices, and foreigners are forced to sell their U.S. dollar assets to attempt to mitigate that problem. Primary dealers are very much willing to buy them because especially they're the most pristine forms of collateral for use in repo, these U.S. Treasuries, and then they hold them on their own balance sheet for those purposes. They're not investments, they're liquidity margin. And then some of those foreign sales end up at FRB&Y building up these dollar buffers for foreign countries. On slides 20 and 21, when all of these things happen, just like a short squeeze, the dollar's exchange value tends to rise, at times often substantially. In fact, there's even a growing body of accepted official scholarship, especially from the BIS, which has recognized a relationship or relationships, if you take it one step further beyond liquidity into the real economy. Less than ideal financial conditions across the world, the dollar rises in exchange value, and then you have negative pressures on the global economy, particularly through the global trade and investment channel. So going back to our federal funds again, and maybe the reluctance of banks at their floor, which is a filter ceiling, however you want to call it, it's another layer of intrigue in the shortage chain. It's not necessarily a crash, but maybe escalating pressures.
And since this is global money, this dollar, or what you call a euro-dollar system, that's why there's one last correlation. Central banks tend to turn dovish when all these things are taking place. It's almost like they're getting scared.
Yeah, in slide 22, we've seen this happen this year already. Australia has cut rates twice. New Zealand went before them. South Korea just recently. Last week, the ECB set itself up for rate cuts in September, maybe even restarting QE. There's even China in its RRR cuts, though that's an even longer and more complex story, even though it's more directly related to the dollar.
Well, Jeff, in the interest of time, we're going to have to leave it here. But once again, and this seems to happen when I talk to you a lot, for every question I ask, I'm left with an answer, but also with 3 more questions to ask in a future interview. So it seems to me there's a few topics that, I think that when you learn what bonds are when you're a brand new investor, at first it seems so simple to understand. It's just a loan. It's a securitized loan, and you get paid back with interest after a certain amount of time, and the profit you make is the interest. And then you realize, as you get more and more into this, that there are so many more facets of the messages that you get from bond yields and what they're telling you about the economy and so forth. And I think we have a few topics here. One is the role of bonds that in the way that banks use them for liquidity, where they're not really serving the purpose of fixed income anymore. They have a purpose, it's important, they're needed in the system, but it's not for the sake of providing a positive return that creates an investment yield. The whole repo system, I think, is kind of analogous to the bond thing. At first, it's so easy to understand. All it is it's a short-term securitized loan between 2 financial institutions, an overnight loan that's collateralized by some securities. But once you get a little deeper into it, you realize the ramifications and implications that the repo system has on the broader financial system, and it's staggering. And then there's the whole puzzle of negative yielding sovereigns, and now we have in Europe at least negative yielding junk bonds. How these things can make sense is absolutely baffling to me. So I guess I'll have to rely on our listeners to tell us what order they want us to cover some of these topics in, but we'll certainly get them in coming weeks as we have you back on the program. Listeners, we've got some fantastic content on deck for you on Macro Voices this week. We're going to have another All-Stars appearance by Professor Steve Keen. For Energy Week, we've got Art Berman, Anas Alhaji, and Tracy Schuchart, call sign Shy Girl. We've got Mark Cudmore coming up on our flagship podcast on Thursday night. And we're also going to do a special for you on Sunday. That's going to be Dr. Pippa Malmgren and her dad, Dr. Harold Malmgren. We'll tell you a little bit more of the backstory on Thursday night's podcast. For the Macro Voices Podcast Network, I'm Eric Townsend.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week, free of charge. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices.